What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. My guests in this episode of Hidden Forces are Vance Spencer and Michael Anderson. Mike and Vance are the founders of Framework Ventures, one of the largest venture capital firms in crypto. They've been on the podcast several times before to discuss their investment outlook for this asset class, particularly decentralized finance and blockchain-based gaming. You can easily find those previous appearances in the related tab on this week's episode page at hiddenforces.io. In this end-of-year episode, I asked the Framework team about their outlook for crypto in 2024 and whether they think the recent run-up in prices marks the beginning of a new bull market. We discussed the anticipated introductions of the first Bitcoin and Ethereum ETFs, the Ethereum roadmap and recent upgrades to its protocol, blockchain-based gaming, regulation, and much more. Because this conversation deals with investing, nothing that we say on this podcast can or should be viewed as financial advice. All opinions expressed by me and my guests are solely our own opinions and should not be relied upon as the basis for financial decisions. And with that, please enjoy this informative and entertaining conversation with Framework Ventures founders Vance Spencer and Michael Anderson. Michael Anderson and Vance Spencer, welcome back to Hidden Forces.
Thanks for having us on.
Yeah, glad to be here.
Yeah, you guys have been on so many times now on the show. I've lost track because you've also been on the Genius community for live Q&A. So I don't know which conversation is which, but I was told that the last time you were actually on the show itself was not so recently. It was the FTX situation, apparently, when Sam got not arrested, but like the whole thing blew up and we're trying to figure out what happened. And Vance had gotten a late night phone call, a 9 p.m. phone call or something like that from SBF, and he broke the news on our show. So our listeners will be excited to hear back from you guys. So for people who aren't familiar with Framework, before we kind of get into this conversation, because I want to talk about the state of crypto today, because a lot has happened. Before we do that, for people who aren't familiar with Framework, just give us, either one of you, give us a kind of synopsis on what Framework is and what you guys do.
We're an early stage crypto fund that primarily focuses on investing in the digital asset space. We started in 2019 with a small fund, and we've since grown our AUM quite a bit. We're now investing out of our third fund. One of the things that I think makes crypto funds very different from traditional venture funds or even hedge funds is that we kind of split the difference in terms of how we like to invest. There's many opportunities that we see where we're putting money in to an equity-based company. That company goes off and builds a product and service, kind of exactly what you would expect with venture capital. But many other times, we're actually buying the digital assets themselves from a protocol that's already launched and decentralized. And so, we look at things in terms of, venture scale opportunities for everything we invest in. But the form factor of how we put money to work can change pretty drastically depending on, the context of where we see those opportunities. So it's a little bit different, but we've probably, been one of the most dominant funds over the last 4 years since we launched. DeFi is really kind of where we made our name in 2019. We've since added, games, Web3 gaming to the core theses that I'm sure we'll talk about today. And, we're still investing in infrastructure and services as well. So kind of run the gamut for everything early stage.
So what would you say the state of crypto is today versus when you guys came on last time? When you came on last time, there was, I don't remember if there was already a prevailing sense of bearishness within the crypto community or outside, but certainly after FTX, a lot of people thought the industry, if not was dead, certainly was going to be in a prolonged bear market. We were in a period of rising interest rates. And what's really interesting is that a few months ago, I think this was middle of October or so, or maybe it was middle of September. Actually, I think it was middle of September. You guys will tell me. But crypto started to pump. I mean, Bitcoin and Ethereum. And they actually led the broader indices, which turned also, I think, in October or middle of October. And then we've since had the Fed pivot. So I'm curious what the state is and what accounts in your view for the bullishness that we've seen that led the broader equity market.
A year ago, we were definitely already in a bear market because Luna had happened in the middle of the summer, or I forget if that was April or May. And then we had kind of a mini resurgence, but still kind of downward price action and sentiment for the fall. And then FTX was kind of the final nail in the coffin with, basically forced deleveraging of all major players. Like the entire CeFi lending market died. Genesis then died kind of, I think, a month after FTX because they had announced that they had put money into it. And we talked about it on this show that I thought that wasn't anywhere close to being enough to cover the hole. But that was also when we were the most active. And Michael mentioned this earlier, but the majority of the fund is liquid. It's just over $1 billion. Most of our mental cycles are spent on venture stuff. But at that time, it was the forced leveraging of all the major assets. And that was very attractive for us. And then we since have had some ups and downs in crypto. We had the January, February, March kind of resurgence, which was basically just short covering and just a violent rip off the lows. But the most recent run has kind of been, I think, from a few things. The first is there's been a lot of real work that's been done over the past, 2 years. A lot of launches, RWAs, games, DeFi. We can talk a little about that later. But the second is just the ETFs and the institutionalization of the asset class, kind of saving it from itself. And, we'd thought about what would be the preconditions for a recovery last year. And, the institutionalization of the asset class was really kind of the only thing that we could see that would take it in a new positive and much larger direction. And so to some extent right now, it feels like it's crypto natives trying to front run these traditional institutions. But I think paradoxically, that kind of won't work. I think most of what crypto is looking forward to at this point is access to trillions of dollars in capital. And that means just far larger crypto assets when combined with potential deregulation of the space that could see a really broad-based resurgence and hopefully, really large amounts of adoption.
What's the reason that people are bullish on regulation after it having been such a source of uncertainty for so many years in the space?
Well, so I think in most instances, when you have new technology, what you want to have is a period of time where that technology can mature, it can gestate, it can figure itself out to the point where sensible regulation then takes over and then provides the path forward, where you don't limit the capabilities of this new technology, this new asset class, whatever you want to look at it as, early along in the adoption curve to where it stymies that potential. And so that's, I think, now where we are, where we're at that transition point of not having any regulation or any real clear rules, guidelines, but now actually having the ability to say, okay, here are the things that are working. Here are the things that we need to do. Let's move forward with sensible regulation for promotion of this industry and this asset class, as opposed to the curtailing of, this industry. And, that transition point, I think, is an important one. There's also, a number of political perspectives, I would say, that provide the backdrop to why, some people think that, this industry doesn't need to get regulated. We can keep on using the 1930s rules and regulations that many have been promoting. But I think, it's becoming more and more clear every single day that there are people that need to know which way to go. And so regulation is really kind of the path forward. We expect that there will be positive movements in 2024 and potentially political opinion changing in 2025 and onwards.
Last thing I would add to that is we've kind of seen the worst case scenario manifest. And you have Coinbase suing the SEC, you have Binance and CZ, settling. You have all of the industry actors that were charged with various kind of things, fairly or unfairly. And I think what we found is that there are now enough projects that are willing to fight regulators and take them to court. And as we've seen with the Grayscale case, as we've seen with pieces of the Coinbase case, the regulators don't always win. And not every team has the resources to take that on, but when that's the prognosis, you kind of have this thawing of the fear of regulators, which has permeated over the past year. And then, it just doesn't seem so bad. It doesn't seem like there's a roadblock to this industry becoming large. It does seem like there's definitely some headaches. The other thing I would say is, to Michael's point, I'm kind of split 50-50 on whether we're going to see a crypto bill or if we're going to just see, deregulation if there's an administrative change. I think it's probably 50-50. Certainly, the Republican instinct is not always to draft more legislation. It's probably just to disregard legislation that doesn't make any sense, like the Howey test. So we'll see. I think the burden of proof is on people who want to regulate the industry in a way that, they have to prove that they can get it done in the next year. And I just don't have a very high confidence level in that.
When you say deregulation, what do you mean? Because isn't the bullish case crypto-friendly regulation?
I think you can have a successful version of crypto in either case. Like in the last Trump administration, the OCC let banks do all sorts of very interesting things with crypto, with stable coins, with holding user balances and bank accounts. And that didn't require a whole new bill. It may have required things like sandboxes and more cooperative regulatory bodies, but it certainly didn't require a bill. And so I do think having explicit carve-outs for crypto is helpful, but I don't think it's necessary in the sense that there's a really positive outcome in either of those lanes if either of those things happen.
So you mean it's more crypto-friendly interpretation of the law? That's sort of what you mean by deregulation?
Yeah, and if you look at things like the major questions doctrine and how regulators kind of exercise their power over the people they regulate, those are things that if they change or if their interpretation changes, and that doesn't require a bill, it requires a Supreme Court ruling, that can be positive for crypto as well.
So actually, one more question about what we were just talking about here. Where are we with the Bitcoin and Ethereum ETFs?
The chances that Bloomberg intelligence folks who track this stuff, day in and day out, they pegged the chances at about 90% plus for the window of opportunity being January 6th through January 10th, this upcoming January. They think that it's going to happen, basically on January 8th. And the more evidence that they collect every single day as these new amendments for these filings go out, just furthers that point.
How much of that is already priced in to the current price in Bitcoin and Ethereum? And how much of that is reflected in the rise in price that happened earlier this year, September, when we saw Bitcoin and Ethereum and the whole market begin to rise?
Yeah, so the way to think about it here is there's been a universe of opportunity for buying Bitcoin and Ethereum, which is anybody who has a Fidelity account, anybody who has a Coinbase account. You can go to the ends of the earth to set up these accounts and buy these things. But what really these ETFs represent is in some estimates I've seen 18, some estimates I've seen, $47 trillion worth of asset value that is held and managed by registered investment advisors, whether these are in 401ks, IRAs, or separately managed accounts that worked with an independent platform to be able to process those transactions. There hasn't been any access to any crypto assets in a direct sense. And what I mean by that is you can go off and buy MicroStrategy, you can go off and buy Coinbase stock, but those are indirect proxies for the asset itself. What the ETF represents is an unlocking of that institutional buy potential for now having a sensible product that is available and something that could be bought by that 18 to $47 trillion worth of assets. And so I would actually say, yes, there's a lot of people that are already in the market that recognize the potential of these rulings, the potential of these approvals, and that's where the run-up has been so far. But what really matters is what happens after the approvals and after the launches, because that's when the real buying starts.
Do we have some sense of the scale of the inflows on a relative basis to what we've been accustomed to, if this actually occurs?
Yeah, there's been a couple of estimates. Galaxy Research put out a good one just based on the total addressable market of how many RAs there are and going through the percentage of adoption. It's a pretty detailed model. They're saying 10 billion. Fundstrat, which is always, Tom Lee, very bullish, very optimistic, which I think there's a case for. Like Bitcoin is the best performing major asset of the year by far. There's some crypto assets that have outperformed
it. 150% this year? Is that right?
150%. It's like more than.
And most of that was in the last 6 months, wasn't it?
Right. And look, you've never had an asset that's been the top performing asset suddenly get institutional adoption. And so that's where you get the higher prices lead to more confidence, lead to higher prices. Anyways, Tom's guess is 25 billion. I think just the lived experience of buying lots of crypto, like 9 figures of crypto in short time frames, and Bitcoin as well. If you try to buy that much, you do move the price. Just you're not trying to do it, but just to get a fill, you do move the price. And most volume, it's not wash trading, but a lot of it is just market makers hitting each other, and there's no real kind of bids or offers being set at the margins by real people. This type of bidding is going to be considerable in terms of its impact to the price. And Tom Lee thinks it's going to 180. It feels like everyone this cycle is at least aiming for 100K. And, we've done that the past 2 cycles, so maybe that's not saying much. But those are kind of the high water marks. And I think if you think about what are Larry Fink is putting his reputation on the line to go out and get a Bitcoin ETF done. If he has less than $1 billion of inflows on the first day, I think you would consider that probably a failure. I think by the end of the year, like what are the other goalposts that make sense to think about? If he's not the number one ETF, that's probably what he's gunning for. Like they're BlackRock. They should be able to do that. They have global distribution and they're one of the world's largest asset managers. So I think that's kind of what we're playing for is, most people think, 100 to 200K. In our lifetimes, of course, I think Bitcoin's going to a million. Like I think the world is a crazy place and that could happen. But, TradFi is going to take most of the ride there. And that's pretty interesting to think about, at least for me.
The only other thing I'd add, and this just came out a couple of days ago, primarily on Twitter. I don't know if it's actually running on any national spots, but Bitwise, is a company who has one of the applications that's going through the same process as BlackRock, came out with, I thought it was actually a pretty hilarious commercial for Bitcoin, which was, the most interesting man in the world is now a Bitcoin fan. What we're also going to start to see is just the massive marketing machine of all of these institutions pushing these products as well. And I think that, you start to walk around some of the airports, and I've noticed a few Grayscale GBTC type commercials and advertisements and such like that. But imagine BlackRock and the other 11 applicants who are probably all going to get approved at the same time, just funneling marketing dollars into promotion of Bitcoin through all the different channels. So I think there's also the narrative that's going to take off starting in January as these approvals go through, that I would imagine just brings things even further back into the limelight.
I just had a visual of myself on one of those conveyor walkways in an airport and passing Bitcoin marketing material put out by institutional funds. That's quite a visual. That really puts it into relief, I think. So this year, 2023, has also been, not only, has there been a lot of speculation about ETFs and Bitcoin and Ethereum, but Ethereum in particular, it's been a big year for Ethereum. What's been accomplished this year, like proof of stake and the rise of L2s? And can you guys give us an overview of the network in general? Because one of the things that I think we did talk about this on one of our episodes together, which had to do with the deflationary supply schedule after the latest upgrade on the Ethereum protocol. So like, where are we with that network today, and how has it performed relative to your expectations?
So I think high level of ETH is you pay gas to perform network operations. If you want to interact with a smart contract, if you want to send money to people, you pay gas. That goes to ETH stakers. 80% of it is burned, 20% of it goes to ETH stakers. So if you stake your ETH right now, you're earning about 4.5%. And if you think about, just today, I checked this morning, there was about 6,500 ETH spent today on gas. And ETH is about, 2.2. So they did $14 million of revenue today. The entire network of Ethereum did 14 million. So the way that 14 million is broken down, 80% of it is burned. And that's where the supply deflation comes from. And 20% of it is given to people who stake their ETH. And so we're one of the largest ETH stakers, and we stake and every day we're earning more ETH denominated income. And what that's powered by is DeFi, it's NFTs, it's people sending money around, and it's also the L2s. And if you think about ETH's scaling roadmap, what it's doing is it's saying everyone will have, their own L2. Gradually, it'll only be institutions interacting on ETH mainnet, but the L2s will post and pay for call data. And so it's basically like the L2 batching up a bunch of transactions, posting it on ETH L1, paying for ETH to kind of have that certified there. And the metric that is relevant is that ETH L2 data has gone from 0.5% of all fees at the beginning of this year to 20% today. And so the L2 roadmap is working. There's significant economic incentives for people to want their own app chain. And that's the market that we've seen grow the most drastically. Like 2 years ago, we thought there would be like 2 L2s, and it was looking like it was going to be like Optimism and Arbitrum. Now, it looks like there's going to be thousands of L2s. Most apps are trying to pitch some version of this idea. So that's been very interesting. ETH has performed typically how we kind of thought it would perform. One of the supply headwinds that it's run into this year has been proof of work miners selling, but also all the estates clearing out their crypto. And so I think broadly, not just ETH, that has kind of been what the back half of this year has been, is just everyone getting through all of this unlocking supply from basically 2021.
Yeah, and only two things I'd add to that. There's an upgrade that's coming up, supposed to be in about the first quarter of 2024, that will reduce the cost of L2s issuing call data onto ETH mainnet by about 10x, so 90% reduction. Just anecdotally, one thing that we hear from existing portfolio companies or new companies that are looking to launch is that they're waiting for that upgrade to be able to launch their Ethereum-based L2 app chain. And I would imagine that the move from right now, it's maybe like 3 or 4 or 5 L2s that are actually putting through that 20% measurement that Vance referenced. I think that Cambrian explosion happens probably in the first half of this year as we see all these different app chains launch. And I would imagine that percentage goes up quite a bit from 20% to some multiple of that. And then the second thing I'll add is we're talking about the Bitcoin ETF, and the timelines for the Bitcoin ETF are early January as we're expecting. The thing that goes a little bit unnoticed is, the Ethereum ETF is also in the same process. It's just about 5 months behind the Bitcoin ETF, the spot Bitcoin ETF. And, really what we're talking about here is anything that has a spot product versus any of the futures products that are cash settled. Those we think are just highly irrelevant to, anything that we're talking about. And frankly, most people don't even want to touch those based off of, the cost structure of running those futures based concepts. So end of May of 2024 is when Ethereum has or a number of the applicants have their final decision deadline for the SEC spot Ethereum ETF. And we don't see there being really any other products that have the possibility of potentially coming to market, mostly based off of the fact that there are not existing futures products for any other crypto asset. So our expectation, and I think this is pretty uniform as well, is that there will be by the end of 2024, there will be 2 spot crypto products, Bitcoin and Ethereum, and those will be the only 2 that really have the institutionalization of the ETF concept behind them. So those are just kind of other things that are coming up in the first half of next year.
So Vance, I think you said it was 14 million just today in revenue that the network generated?
Yep. So they're at a 5 billion run rate for the network.
Okay. Is that a comparable statistic to firm revenues? Or would we have to look at proof of the staking revenue to determine that?
The reason why we love crypto is because it's better than company revenues. There are no expenses that flow through you staking your ETH and the income that the network produces. It just goes directly to you. And as an ETH holder, think of that 14 million. 20% of it, 2.8 million goes to stakers. The other remaining part, the 11.2 or whatever, is burnt. And you benefit from not just the yield that you get every year, but from the deflation and the removal of ETH tokens from the market.
But how do we think about all the costs associated with running the network? And do we just look at the costs of maintaining Ethereum, or do we also look at the cost of all the applications that are running on the network at that time? Is there a metric that we can use, like price to free cash flow, that's analogous when comparing or thinking about a blockchain-based ecosystem versus a company?
So the example that I think highlights kind of what you're getting at, Demetri, is the proof of stake transition from proof of work to proof of stake. That was September of 2022. The highest cost structure of being a miner on the Ethereum network prior to the proof of stake merge was running the infrastructure and actually performing the calculations just like you would have with any proof of work, mining operation. But the energy consumption, the amount of cost associated with running a node, whether you're mining or you're validating, went down 99%. So it would be like saying a company just immediately cut its cost structure, its unit cost structure by 99%. And now that value that was flowing through it is maintaining and still continuing to flow. It's actually grown quite a bit in ETH terms since the proof of stake merge. But you're also being able to have that value flow through in different ways. And so that's, I think, how we think about it, like Vance talked about, there's direct value transfer. So there's 3 components to it. There's the value that people are paying, the 20% that flows through to stakers. There's also an inflationary reward that is going to stakers as well. So even if Ethereum were to drop, the revenues were to drop to 0, stakers would still have the inflationary reward that they would be earning for processing the transactions on the network. And then there's the component that's burned. And altogether, those are the value transfers. They come in different forms, whether it's deflation or new assets that go directly to stakers. If you own Ethereum, you participate in the deflationary effect just because your Ethereum becomes more over time for the entire network. And if you want to stake, you can participate in the value transfer that's coming from the revenue direct or the inflationary rewards each block that are flowing to stakers. And so there's different ways of participating, which is different from any, capital stock structure, where if you own the stock, you're going to get the dividend no matter what, or you're going to participate in the buyback no matter what. There's different levels of participation, which means that there's different levels of value accrual for that participation.
So was this deflationary supply schedule instituted because the developer community and the stakeholders of the Ethereum community are ultimately doubling down on the financial aspects of the reward mechanism as opposed to the value creation of underlying use cases to drive interest in Ethereum? In other words, there's another way of saying, are we still in a place in crypto where the two biggest chains, Bitcoin and Ethereum, are driven primarily, if not entirely, by speculative energies with an expectation that people are going to make money by buying in ahead of some other thing? Or are we getting to a place, which, by the way, I think is in some sense validated by the revenue numbers versus what the actual market cap of the network is, even if we don't even take into account costs? Is this still where everyone's head is at in terms of long-term, how value is going to accrue?
No, I mean, the reason for these major changes, and by the way, these economic changes went in with something that was called EIP 1559 the summer prior to the merge. So, some of these changes were 2 years old. Some of these changes are just a year and change old. But really, the reason for these changes has nothing to do with the speculative nature of the asset itself. It has to do with the permanent proliferation of the network and making sure that, in the words of some of the Ethereum core developers, that Ethereum is a World War III survivable network, that even if it goes down, in partial ways, or even if there's changes, in malicious activity, it will survive, just about anything. And that's where the economic security and the elements around staking with that security and the incentive structures around it really come into play. And so I would say it's, very low on the speculation side in terms of where these changes and the intentions behind them, very high on the security side.
Okay.
Just to give you a sense of proof of work versus proof of stake. So proof of work costs 2.5% inflation per year to run. So the market cap of ETH is about, call it 250 billion. So that's $7 billion of expenses to run that network. With proof of stake, it's about negative 1%. And there is some inflation with proof of stake, but there's much less than proof of work. And the delta of, that inflation to get to the negative 1% is all the ETH that's burnt in those transactions that we were talking about earlier. So it kind of has nothing to do with speculation. It has more to do with how do you build a sustainable business? And with crypto, it's different. It's how do you build a sustainable protocol? And frankly, I think sustainable money. Because Bitcoin's great, but they're doing 2% inflation as well, and they're at 400 billion. So that's 8 billion of expenses to run the network per year. And if you want sustainable internet money over the long term, you need to have both a balance of, okay, how much of this am I inflating per year? But also, what's the best mechanism to accomplish that? Because proof of work is just structurally more expensive. There's benefits to it for sure, but it's just more expensive.
So I want to get into two use cases that we've talked about in separate episodes on the show together with you guys. One is DeFi and the other one is gaming. Before we do that, I just have some specific questions. Well, one general question about the changing thesis in the space with respect to what drove it in 2017. But before I ask you about that, a proximate question has to do with Salana. So I've seen Salana ripping, and I'm just trying to understand how that is because I thought it was dead. So what exactly is going on there? What accounts for that? And also give our audience, and give me too, because I don't remember exactly what had happened. It's been some time since Salana had tanked, and I remember what it was exactly that had happened. But what's the deal with that over there? And is that further evidence of the fact that the biggest driver in crypto is ultimately network effects, and once you've got enough people that are invested in your protocol, they sort of will it back into existence, into relevancy?
So I think last time we spoke, Salana was at $9 or $10. Now it's at $70. And so it's had quite a resurgence. And I think the resurgence has been powered by two things. One is the architecture of Solana. It's what's called a monolithic chain. So basically, it is economies of scale, large data centers, large validators, and the network is super cheap. It's probably slightly more centralized, but all of the activity, value capture, whatever you want to call it, happens on the one Solana layer versus this web of L2s. And I think there is some credence to that architecture. And there's now a lot of chains that are doing this or that claim to have done this, but it's a narrative in crypto, I would say for sure. But I think what sets Solana apart from the other chains that try to either push this narrative or construct them as this more centralized type of chain is the, frankly, real work that's been done on Solana by all the ecosystem teams. So we're one of the largest investors in the largest liquid staking token on Solana. It's kind of like Lido plus Flashbots for Solana. It's called Jito. And, those guys have just showed up every day for the past 3 years and just eaten glass through the good and the bad. And they've definitely developed a formative community that's still kind of taking shape. The chain is still pretty far behind basically everything else in terms of Ether Bitcoin, in terms of actual usage, lending volume, trading volume, things like that. But with the launch of meme coins and things like that, they've definitely had a resurgence of on-chain activity. But I think, generally most chains don't have like the good or bad fortune to have either something really, really good or really, really bad happen to them. Like they don't have like a narrative defining event. Most of these chains just kind of like flutter and die. But Solana has definitely had like the SBF halo while it was good, and even the sentencing and trial while it was bad. And so they've definitely kind of developed the underdog mentality. I think where Solana is probably weaker than ETH is, the DeFi is an order of magnitude smaller. They don't have a decentralized stablecoin. They don't have big lending markets yet, but they do have interesting kind of new NFT concepts that are compressed. And so they have different kind of form factors and functions that they can play. But we'll see. It's definitely a contender to be kind of one of the chains of crypto.
So how does this fit into the larger L1 thesis? I don't want to call it the ETH killer thesis because I think it's pretty clear that ETH's not going away. But is there room for other layer ones? And then that speaks to this like multi-chain thesis where you also have cross-chain interoperability, and that brings in a conversation about Chainlink and other Oracle networks. So like, where are we with that? Is there room for other layer ones? How is the architecture of the space evolving to allow for something like that? And if so, what do you guys think are going to be? Is it going to be, besides Solana, what other layer one solutions have viability in your view?
So I think when you really break it down, the things that matter, and we're talking about things that matter for a developer, not necessarily for a user, but the things that matter for a developer are really threefold when you're choosing which blockchain you want to use. It's transaction throughput, or therefore cost. Solana will probably have the lowest cost associated with it to be able to run those chains, just based off the fact that it's monolithic. The hardware requirements to be a node operator are pretty robust. You're going to be able to get the most transactions through that node. And that's really kind of the scale that they're competing on. Then you've got the security model. And the security model is a little bit, nebulous. It's really kind of how much trust do you put in the network and the security of, everyone running the network. Does it go down for periods of time? Is it, something where you want to be able to put hundreds of millions or billions of dollars of assets on it, like Ethereum? And then the third is really just kind of the network and activity and value that exists in that ecosystem already. Are you trying to build a group of users yourself, or are you able to take on, the other users that are around that ecosystem and kind of assume that they'll come to your protocol application, whatever it may be? And so, those three factors are the things that matter, really. But I'd say there is space for anyone who's able to spike in any one of those different categories. And so what I mean here is, the security model, well, Ethereum has the best security model. It has the most Lindy smart contract platform so far. It has the highest level of economic security based off of the staker values. That's where people want to keep their assets because that's where they know that they can trust those assets. Then you've got transaction throughput. Like we said, Solana has the advantage here, but that's also where L2s on Ethereum will continue to play because they will reduce the transaction cost and maybe potentially even abstract the transaction cost away from that. And And then I think the third category, and we can touch on this, maybe now or later, but games is really going to be the thing that aggregate towards where there already are users. Ronin is a blockchain where you had Axie Infinity in 2021 exist. They still have hundreds of thousands of daily active wallets transacting on the Ronin blockchain as a remaining vestige of, 2 years ago when Axie was, 2 million or 3 million players. And so I think you're going to start to see games or other consumer-oriented applications aggregate to places where users already exist. And so I think this third component is going to be the thing that we're looking for, as we grow the size of the pie in 2024 and on, because that's really where, users is going to become the North Star metric going forward.
So let's talk about that, because gaming was always the use case that I thought was going to be, that had the greatest likelihood of being the major consumer app early on, even before DeFi. And it hasn't proved to be true, at least not in the time frame that I thought. So where are we now with that? What excites you in this space? And like you said, you guys are big investors in this. We did an episode, I think the episode that we did before the SBF episode was on gaming. So catch us up on that. What games are coming out soon? And what is the value add here? And then also, how do you address all the gamers who don't want this, who are constantly speaking out against blockchain-based gaming or tokenized assets, in-game assets on some of these Reddit forums and other places online?
It takes a ton of time to build a game. And so that's kind of where we probably have miscalculated in the past. It takes 2 or 3 years minimum to build a game, and you need a ton of resources to build it. You probably need $200 million plus if you want to build a AAA game. And there's certainly ways to get it done with much less money, but that's kind of what you're looking at. And so, really all the games started being built in early 2021, if that, probably late 2021 is more realistic. And so all of them are basically launching next year. We think there's probably going to be 50 in the first half of the year. And so it's not, going to be too much longer from now for these things to really launch and prove themselves. The thing that Michael was talking about that I just want to piggyback on is it's still so early in crypto. We were looking at one of the top wallets on Salana the other day. They've got 10, 20, 30,000 daily active users. And it's all prosumer type people that are swapping meme coins, buying NFTs. And Ethereum in many ways is kind of an even more power law distribution of users than that, where you have massive whales borrowing tens of millions. You have NFTs trading for much higher prices. But what we haven't seen is the long tail of consumers come into crypto with purpose. And to Michael's point, Ronin still has 200, 300,000 daily active users. Immutable X has probably 100K. But if you can get 1 million or 10 million users on chain, you're one of the biggest, if not the biggest ecosystem in crypto. And so that's where things can change quickly. One of these L2s gets hot. Immutable X picks up more games, maybe even Ronin. Solana has kind of pivoted away from that. It's focusing on more of DePIN. And so whoever wins gaming is going to be probably a top 10 chain. But frankly, we just haven't seen any kind of games launch yet. So that's where I would expect the most volatility in terms of, who's important in crypto.
So what are these alternative layer 1s or layer 2s doing to try and attract developers to their platforms?
A lot of it is a venture capital game almost. You're trying to woo developers. You're trying to build software products that allow you to do custodial interactions with smart contracts, but it's capital intensive. Immutable X, and frankly, we're investors, so we're biased, but they've got $270 million in their balance sheet. And that's not tokens, that's cash and, ETH and Bitcoin. They certainly have, another $1 billion or so grants program that they're giving out, but you have to be extraordinarily well capitalized to go after these things. And so, if you think about it, just filtering, okay, who was in gaming 2 years ago that's got a head start? Only 10 people. Who has 250 million on their balance sheet? It's probably only 5 people. Who has software that can allow you to do custodial interactions, smart contracts? It really is super specialized, and you're betting the farm on gaming. There's no way that a DeFi ecosystem is going to save Immutable or Ronin if gaming doesn't work out. But in many ways, gaming is the largest user base. There's 3 billion people a year that play games. They look, act, and feel like crypto people. They interact with digital economies. This could be everything for crypto. And I think it's just a matter of time.
And Demetri, to your point, just to add a little color to this, the ways that you're going to get users that are coming in for a consumer application, we think consumer is going to be games at first is a very different proposition from someone coming into DeFi or Web3, NFTs, what have you. There's got to be no gas cost. That's number one. There can't be, this complicated MetaMask style wallet that you have to sign up for, save the private key, all of the above, and you have to fund it. Like that can't happen. And you have to not really have any sort of blockchain elements when people are interacting with these ecosystems. So you have to kind of abstract away everything for you to be able to get the 1 to 10 million monthly actives, daily active wallets transacting. That's the playbook for what these game ecosystems are going to be doing in the next year. And so that's where I think, we're going to start to see, it's not going to be who has the most, L1, L2 usage and, how many users are transacting. It's going to be so huge that it just dwarfs, the Salana and the Ethereum ecosystem daily active wallet numbers, just based off of the fact that they've abstracted it away. So I think that's going to become the new narrative.
Are there any roadblocks that you see for adoption in gaming?
Not really. There's nothing that would prevent it from happening. I think we trust there's been probably $5 to $10 billion invested in crypto games, and there's probably hundreds of them. And so one will work. We launched 5,000 tokens last cycle. Probably 30 or 40 or 50 of them are real businesses. And I think you're going to see that same scale of experimentation with games alone. And so if you hit one, that's all you need. Axie Infinity, although it was not the game that anybody wanted, it drew millions of people on chain and was a $30, $40 billion market cap token at the very peak. Of course, you want to make it more sustainable. But if any game gets to that scale again, they're going to know much more what to do than they did last cycle. Last cycle was just it was whatever games were being built in 2016, not necessarily by gaming teams, and they ended up being kind of a disaster once they unwound. This time around, I think we're going to have just a better informed view on kind of how to make it sustainable.
So where are we now with DeFi? Let me maybe be more specific. DeFi summer was 2020. There was a ton of excitement around that. That was the first time you guys had come on the show. Going forward, do you see this as another really important use case? And why don't we hear as much about DeFi today as we did a few years ago?
So I think DeFi, back in the DeFi summer days, which was the launch of, I think it was marked as the start with the launch of the comp token, the compound token. And really what DeFi summer represented was inflationary rewards being distributed to users who were, moving assets around in a unsustainable way, let's say. Where does that yield come from? It's not coming from activity. It's not coming from, real assets. It's coming from inflationary rewards by and large. I think, what that does is it does bootstrap and kind of jumpstart a community around these different ecosystems. And, to Vance's point, we launched thousands of these ecosystems and some of them, have persisted. They've survived through the bear market. I think where we're looking to now is a transition from having assets on chain that are, circular in nature to these ecosystems. But now what we're doing is we're bridging the gap between the real world and the traditional and the crypto world. I actually, hate the term real world assets, but traditional assets, it's, I think, non-descriptive and kind of the incorrect way of describing things. But really, it's traditional financial assets that we're bringing on chain, tokenizing, and connecting that digital and analog world in a way that generates real sustainable value.
Which was always something that we'd heard about from the earliest days, this tokenization of assets. We saw it for example, deeds in real estate. So what is the difference today versus what people were talking about back then? Or is it just they're repackaging it because they think we're finally at a point where there's going to be adoption around it?
Well, think of it this way. If you were to start from the ground up right now, and you're going to build BlackRock from the ground up, or any financial institution from the ground up, the technology stack that you would choose is Ethereum as the base level for how you do back office processing, how you do management of assets, how you do custodianship, how you track payments. All of that living in an immutable blockchain that's transparent and auditable and custom is something that that's how you would build those companies from the ground up now. we're seeing a number of issuers that are going after that business model right now, that are creating, financial assets, or they're taking financial assets and putting them on chain and allowing for financialization to take place. And these are broker dealer license. These are, companies that have their own ATS. So, they're doing it in compliant ways with existing rules and regulations, but they're doing it with Ethereum as the back end, as opposed to, building their own tech and using databases. So that's where I think DeFi starts to go. It becomes the backbone of financial services in the same way that we thought, that would be the case when we start to put these assets, tradable on the NASDAQ. We're going to start to bridge the gap in between the DeFi ecosystem and traditional financial services, that eventually this is all just sort of a different tech layer as opposed to different, communities and different use cases.
So when we started the show, I asked you guys about the bullish turn in crypto that started in, I think it was mid-September, and that it preceded the turn in equity markets and also the Fed pivot that was, a week or so ago, whenever it was. Do you guys, and this has long been one of the running prevailing views, which is that crypto is kind of a canary in the coal mine for liquidity, for changes in liquidity. So what I'm about to ask you is sort of a macroeconomic question. What do you guys think is going on here? Is this the start of a new bull market driven by a changing tide of liquidity that's going to broadly impact equity markets as well? Or do you think that this is just a head fake for now? Or is it something where maybe it's not this term, maybe it's later, but where crypto kind of disconnects from traditional finance and from the underlying economy and becomes kind of a way of protecting the value of your money in a situation where governments might be forced to monetize deficits, et cetera, et cetera? Like, what is your overall thesis about where we are and where we're going?
I think the first thing is it's funny that the burden of proof is always on crypto to prove that it can come back. This is like the sixth time we've done this. And every cycle has kind of been, obviously you didn't see the large scale fraud ever before, but the ICO bubble was terrible. Like that was a retail bacchanal. It wiped out so many people. And then the previous three cycles before that were also terrible in their own way. And I think what's interesting about crypto is that digital gold is a very interesting concept. Sustainable internet money is a very interesting concept. And most old people don't understand it or necessarily like it. Crypto is two things. It's a demographic, it's a geographic phenomenon. Very popular with young people, very popular with people internationally. And if you think about the things that are going to matter over the next 20 years, there's going to be tens of trillions of dollars passed down in inheritance. And those people don't want to go buy like cyclical value stocks or like utilities. They want to buy things that they know that they think are interesting and they're culturally relevant. And what do we know those as? We know those as tech stocks and crypto. And you don't really get to see the birth of a new asset class every 10 years. It's a once a century thing. And so you have the background of the deficits and high interest rates, and there's been a lot of words spoken about that. So kind of don't need to go into that here, but the government is only going to print more money. And a lot of the inside assets that are already owned by large institutions are fully priced. Sure, the tech stocks might keep going up, but other than that, the only chance for people to really make it and think about assets that can change their life, it's maybe as sad as like FanDuel and crypto. And so that's what I think the long-term prognosis is. And the last thing I'll say is that if you go to any international country, the things that are interesting is a lack of a tech ecosystem. Most people have not gotten rich on tech stocks. They have not known anybody in their lives who've started a startup and sold it to Microsoft. The game in town in all these international countries is buying crypto, because you might not know anybody who's gotten rich off of tech, but you for sure know people who have gotten rich off of crypto or Bitcoin or ETH, and you always have those legends and stories that are passed down. And so for whatever the reason, it's the asset class of young people and geographically diverse people. And I think that's a pretty bullish holder base to think about. And if you have institutions on top of that, it gets even better. So, we're turbo bullish crypto, Bitcoin to 1 million, ETH to 100K. Sure, someday I think the world is a very crazy place, but I think this is the beginning of that journey. Like, as I said, TradFi is going to take most of this ride if Bitcoin goes to 1 million. And so the asset class will look a lot different in 10 years. And hopefully for the better.
Yeah, I completely agree with all of that. I'd say maybe just the short-term perspective is we've never had, the cycle that we've been through that creates crypto to be the anti-fragile industry asset class that it now is. We've basically blown up everybody, a lot of the institutions that existed 2 years ago, they're not coming back. We get a chance to rebuild and recreate. And to Vance's point, it's going to be institutional, adoption that takes over the next narrative because they want their slice at, getting a piece of this thing. And, January, we talked about the Bitcoin ETF. There's another thing that we didn't talk about, which is the halvening. And that's something that's coming up in March and April, where half of the inflationary rewards for the Bitcoin network are actually reduced. And historically, what this has led to is a pretty massive run up in the 12 months after the halvening. So that's another catalyst that a lot of people are looking towards. And then, based off of what happened last week, we're expected to have 2 to 5 rate cuts in 2024. And so the rate cutting environment, I think, is good for, to your point, Demetri, liquidity in general, asset values in general. And so, those three things coinciding in the first half of next year is a pretty attractive opportunity that we see in general. But also every 4 years, we go through the same cycle, which is, you have a massive run up, a massive drop, and then you have another kind of bear year, and then it starts to build up again, another massive run up, another massive drop. And we're right at the start of that going back up year. And so even if we just think as implicitly as every 4 years this happens, we're at the start, the first inning of the bull market for the next 2 years.
So this is kind of a restatement of a previous question I asked, but in a way that's meaningful. So my question basically is, do we really need, we talked about gaming, we talked about DeFi, but do we really need any of those use cases to actually justify the speculation that we see in Bitcoin and Ethereum? Because no one needed a use case for gold in 1971 to buy it, and they would have seen it go from an official price of $35 an ounce. I think it was something like low 40s where you could actually buy it at the time, to $800 an ounce in the span of 10 years. But no one, of course, was saying, well, what are the new use cases for gold to justify? And I feel like my sense has been that this continues to be, while there are conversations about things that you can do, and we just had some of them here, that the vast majority of people really focus on this as a speculative asset, but also in a weird way as a kind of wealth preservation tool, kind of just like gold. Gold was speculative in the 1970s, but it was also a vehicle for wealth preservation. Do you think that that's still kind of the dominant paradigm in most people's minds? And is it necessary for Ethereum and Bitcoin to actually do anything other than just be a place that people put money into in order to continue to go up in value over the next 10 years?
Yes and no. At a certain point, you need to have ecosystem chain sustainability in terms of your revenue should exceed your costs for this thing.
Why?
If you want it to last hundreds
Why,
of years.
though?
And
because you and I went to dinner. People that were on our live Q&A know this, because I think we went to dinner. It was in September maybe this year, and a couple of folks were there, including someone who has previously been on the show, a hedge fund manager, and we were talking about what are some interesting investment opportunities, and he rightly identified bonds, which have done quite well if you had bought them at the time, and you laughed. And you kind of laughed with the sense of like, that really doesn't move the needle for me. Are you joking? Like the return, you sort of asked them, what are the potential returns for bonds? And the fact is that people that have invested in crypto during down cycles have consistently made life-changing amounts of money. And I feel like for a lot of people, they're just kind of asking, one, what does it really matter at this point, what it does based on the performance of what people buy it for, which is to make money? And how many times can they continue to do this? And this has always been the case from the very beginning with Bitcoin. The macroeconomic backdrop is why Bitcoin and all of crypto began as an asset class. If we didn't have the great financial crisis, if we didn't have the expansion by trillions of dollars of the Fed balance sheet, I don't think this thing would have ever taken off in the first place. And I feel like the halo effect of that macroeconomic backdrop continues to be the thing that drives it. And it's not clear to me that anything else is really required to move it forward.
I mean, I'm happy the Fed is cutting interest rates. I'm happy, all this easing is happening. That is a tailwind, in my opinion. And, sure, like Michael and I, we're both buying ETH at $3 and, we've done all these amazing things, but like the real stuff when you get it right is when you combine the fundamentals with the speculation, with the right macro backdrop. And like, we're talking about games with millions of players that could become the largest blockchain ecosystem. Like that's where you get the combinatorial 1,000x, 10,000x. Like that's like what we're aiming for. And to your point, the guy said, rightly that I should buy bonds and sell all the crypto in the fund. But frankly, the crypto has performed much, much better, even though he got the bond call right.
And that's been consistently, that is the craziest. I think of all the crazy things about crypto, it's that weirdly, and this is in no way to suggest that what you guys do in particular doesn't require a different level of intelligence, et cetera, et cetera. But what's remarkable about crypto as a category is that you could be sitting with pencil and paper in the rest of the world trying to find, really smart ways to make money. And this asset class has continued to outperform everything else over and over again, despite the amount of brain cycles that you devote to trying to figure out some kind of an alternative. And people see that, which is why I think the case that you could see be, with your luggage walking through Kennedy Airport and seeing posters for Bitcoin and ETFs makes sense, And you could see a flood of retail in because retail investors have seen this and they're just waiting for a final moment to FOMO into it.
I actually don't think that this has been retail at all. I think if you went even to my friends in San Francisco or New York or wherever they are, if you went to 10 of them on the street and said, hey, where do you think Bitcoin is right now? I bet you 7 out of 10 of them couldn't tell you that it was the best performing asset class, that it's, up 150% in 2023. All the catalysts that we're talking about. I bet most people really don't recognize this. I think the retail fervor hasn't even begun to kick off yet. I think what this whole thing has been over the last 6 months has been institutionalization and institutional adoption leading up to some of these retail elements. But, we talked to a number of institutional investors or LPs of ours who are, in this industry, who have friends who are not in this industry. And basically every single one of them, and they're knowledgeable enough because, there are LPs. But if you ask them how many of your friends could describe to you the distinction between Ethereum and Bitcoin, it's like 1 out of 10, maybe. And so I think, the knowledge adoption curve is probably something that'll happen for the younger generations first, but the value is in the older generations. And so I think, 2024 is going to be a year where we start to make that change. It's like saying, what's the difference between oil and gold from an asset perspective? They're just fundamentally different things. And when people start buying this stuff and looking at their financial statements each month and saying, oh, well, why do I have this, ETF and this Bitcoin ETF? Like, what is this stuff? That's when people will have the incentive to start learning more about it.
Yeah. So guys, a pleasure as always. How do you guys communicate with the public? Like, what are the ways that you guys do outreach? Do you publish research? Do you put out threads on Twitter? What can people do to learn more about Framework and what you guys are thinking about and doing in the space?
Follow us on Twitter. Follow myself, follow Michael, follow the Framework account. I think one of the cool things about being a fund manager in this space is we've kind of grown up and had awesome success and obviously taken our lumps too in public. And we publish basically all of our thinkings, our research, our positioning. And yeah, we've got a retail army behind us, which is cool. Sometimes it's a bit weird, but it's cool to have the whole community behind us. And we started trading on Binance as retail and, on Ether Delta. And so people have we've been on the journey with folks. And if you kind of want to get some more exposure, just come and follow us.
And what do you want to give out your Twitter handles?
Yeah, mine is Pythonism, PYTHIANSIM.
Yeah, mine's I'm_Manderson.com.
And I'm pretty sure you guys will both agree, for the very bullish based tweets, we would go to Vance's account. Is that correct?
not if our chief compliance officer has anything to say about it.
Right. I've dealt with your compliance officer, actually, so I know how strict she is. So, guys, thank you so much for coming on. It was great having you on.
Likewise. Thank you.
Thanks, Demetri.
If you want to listen in on the rest of today's conversation, head over to hiddenforces.io/subscribe and join our premium feed. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, you can also do that through our subscriber page. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. You can follow me on Twitter at Kofinas, and you can email me at info@hiddenforces.io. As always, thanks for listening. We'll see you next time.